Let's keep responding to comments. This is commenting on my first lien HELOC explainer video. J Hill 6033 says, why would these lenders allow us to do velocity banking? What's in it for them? Are they doing well enough in loan origination fees plus the interest over time? Thanks for your question. This is a great question because this shows that you have the abundance mindset. We want this to be a win-win scenario. We don't want the bank to go bankrupt because we're just fleecing them for all they're worth. That's not what we want. We want it to be a win-win scenario. And the answer, of course, is that it is profitable for the bank. This is still a profitable product. It's maybe less profitable than a mortgage, but it's still profitable. And I would say for the bank, there's a trade-off. Yes, the first lien HELOC is less profitable than a mortgage. However, for the bank, and here I'm talking only about the banks that specialize in first lien HELOCs. So let me be clear. I'm not talking about JP Morgan Chase or Bank of America. I'm talking about the banks that specialize in first lien HELOCs, where they really do only first lien HELOCs, or at least they have a division of the bank that only does first lien HELOCs, where they understand velocity banking. They have an ambassador program, so they're vetting their borrowers. From the bank's perspective, there's less risk. And banks, generally speaking, are willing to accept less interest, a lower interest rate, and less profit if there's less risk, which in this case I would say there is because the borrowers are going to be more responsible and more educated. It is harder to qualify for a first lien HELOC than it is a mortgage. And we're not just talking about credit score and debt to income ratio and things like that. We're also talking about the education involved because to use a first lien HELOC product correctly requires that someone have at least a basic understanding of velocity banking. That's why they have these ambassador programs. But if you think about it from the bank's perspective, it may be less profitable than a mortgage, but it's also less risk and it allows them to differentiate. So these more niche lenders, it's hard for them to compete with the big boys. I wouldn't want to compete with JP Morgan Chase or Bank of America or Wells Fargo. Those guys are giants. I don't want to compete with them. So if I were trying to offer mortgages, now I'm competing with the big boys, right? So even if the product is in theory more profitable, it's a much more crowded space. I would rather be a big fish in a small pond. So when they sell first lien HELOCs, it allows them to differentiate. So they're not really competing directly with JP Morgan Chase or Wells Fargo. You're not going to hear about those banks really pushing first lien HELOCs and velocity banking. So it allows them to differentiate. Paradoxically, even though it's a less profitable product, it's actually more profitable for them to do this product, this strategy, because then they don't have to compete directly with the big boys. And then I would also say, from a cash flow perspective, there actually are benefits to the bank. Yes, the bank is going to be making less in interest in volume. That's true. But they're also going to be getting more cash flow. You're sending much more of your cash flow into the first lien HELOCs. From the bank's perspective, that also reduces risk because they know the consumer behavior is going to be sending large amounts of money into the first lien HELOC regularly, and that reduces the risk for the bank. Now, from an underwriting perspective, I think they underwrite the HELOC just like they would underwrite any other HELOC. So they're assuming that you're going to do the worst possible thing, which is just pull the HELOC, max it out, pay interest only, and then pay it off after the draw period is done, which would be the worst possible scenario from the borrower's perspective. From the bank's perspective, that would be the most profitable over the long run, but it would also take them longer to get their money back. So it is true that they make less in interest by volume, but they get more cash flow sooner. So that reduces the risk to them. And I think they attract a better, more sophisticated borrower, which is good. And there are other use cases as well where people might be using their first lien HELOC to finance real estate properties so that they're constantly putting money into the HELOC and then borrowing it back out. So the bank is constantly making money off of them, off of the interest there. And the borrower is still happy about it because they're making more from the rental properties they're investing in, and the liquidity provided by the HELOC is phenomenal. But thank you for your comment. Certainly, it's profitable for the bank. It needs to be. I don't want to ever present it like were trying to fleece the bank. And I never want to present it like wealth is a zero sum game, which is why I never understand why people obsess over fees or how much interest the bank is making. I like what Todd Langford said. He said, I don't care if the bank is making a lot of money if I'm making more and it's more favorable for me. I don't have the scarcity mindset. So just because someone else makes a lot of money doesn't mean they stole a lot of money. Why would you assume that? Maybe they made a lot of money because they added a tremendous amount of value. That's usually what happens. And then he responds again and says, I knew it had to make financial sense. Look forward to that video. Yes, perhaps I will do a video on that explaining why this makes sense from the bank's perspective. I'd probably get Anthony Rushing on for that one. We can talk about it. Thanks for your comment. Simply Saved 1519 says, started off good. I wish he would have just let Logan talk. Finish a thought before jumping all over the place, trying to deal with too many angles at once. Just let the guy talk. I couldn't continue watching it, but I'm sure it's a good video. Thanks for your comment. This was on our first interview with Hutch of Banking Truths on combining first lien HELOC and velocity banking with infinite banking. Yeah, it is challenging when you're in an interview setting to keep the conversation focused. Depending on who you're talking with, it can be all over the place. But yeah, thanks for watching. Maybe at some point you can stomach watching the rest of the video or maybe some of the other videos on my channel that are a bit more focused, not interview style. But thank you for commenting. Really appreciate it. Let us know if you're implementing any of these strategies yourself. Love to hear where you're at. J. Cox 1982 comments and says, Logan, I appreciate talking to you today. Great insight you provided me on some short and midterm steps to take that'll help my situation. Thanks again, and we'll continue to talk. This is commenting on Talk to Us First. This was a great little interaction we had. We actually, that video, Talk to Us First, was responding to an earlier comment that J. Cox 1982 put saying that, yeah, I'd like to speak with you, but I've got a few things to square away on my side first. And we created this video to explain why you actually want to talk to us first before you start making any financial moves. We can help you make the right financial moves. And if you're not ready for infinite banking, if you're not ready for velocity banking, if you're not ready for a first lien HELOC, that's fine. We can accelerate the process, optimize your cash flow, and get you in a position where you can do it sooner and better and avoid pitfalls, avoid financial mistakes. So you don't wait until after you get better to go and see your doctor. You see your doctor today while you're sick so you can get better. So come talk to us today. He did indeed schedule a consultation with me. He's not yet in a position to qualify for a first lien HELOC, but I was able to help optimize his cash flow. As an example, one of the things that you can do, you can save hundreds of dollars a month in internet and cell phone by switching over to your local cable provider, might be Comcast, Spectrum, Cox Communications, and bundling your internet with your cell phone. Typically on the internet side, there's some modest savings, but there can be tremendous savings on the cell phone side because the cable companies are not really trying to make money off of providing you with cell phone service. From their perspective, it's more of a loyalty play so that we'll stay with them on the internet side. That's really where they make their money. So I've definitely proposed that to some people and saved them money. It's part of my cash flow optimization exercise. There's never a bad time to be saving $300 a month because you talked to me and I showed you a way to optimize your cash flow. There's never a bad time to do that. If you're not ready for these more advanced strategies, that's fine. We can talk about it. And I would also say don't self-select out of the process. Maybe you're not ready, but after I review your situation, maybe we can determine you are ready, or at the very least, we can put you on the best, most optimal path to be ready to do infinite banking or velocity banking or whatever makes sense. Maybe we're just taking out a convertible term policy. Maybe we're just having a conversation. It's never too early for a conversation. And the sooner you talk to us, the more help we can provide and the more information you're willing to share with us about your financial situation, the more we can help you. Good, bad, or indifferent, I don't care what your financial situation is, we can always help. So I'm glad to have a real life case study to show how we helped someone who's not yet in a position to do the first lien HELOC. So thanks for your comment, Jay Cox. It was a great conversation and great to talk to you. Aloysia H7R says, very helpful. Thank you. Thanks for comment. Appreciate it. This is on the Crowd Health Explainer video. Crowd Health is an alternative to health insurance. It's actually not health sharing, although that's also an alternative to health insurance. It's technically a crowdfunding platform for healthcare. And I've had Andy Schoonover, who's the CEO of Crowd Health, on my show. Let us know if you did you switch over? Let us know if you're implementing Crowd Health. Thank you for your comment. Cameron J4W comments, come on, Chuckles, Miggy, nothing but love. And then I said, thanks for your comment. DeAndre is indeed a very positive guy, unlike me. So hopefully we complement each other. Cameron J4W comments and says, 100%, you all could have a sitcom. Yeah, that would be great. I'd love to have that. This was commenting on that same video. Talk to us first with DeAndre Clayton. DeAndre is definitely a very happy, positive, upbeat guy, which is great. Thanks for commenting, Cameron. Appreciate it. On the same video, Cameron J4W comments again and says, it's crazy how people get caught up with years to breaking even, required premium, paying interest. Like when you think about it, all those things are good. If we pay interest to the insurer for policy loans, they are more profitable, which makes our policies even better. There are so many, like even being forced to pay premium or the policy will lapse or go into a non forfeiture clause. It forces us to make better decisions. Yep, I totally agree with you, Cameron. People get caught up in details and they seem to miss that there's no free lunch. It's always 6 to 1, half a dozen to the other. They might obsess over one negative or positive component of any financial strategy or any particular product, missing the bigger picture. You see this with infinite banking, you see this with velocity banking, where they'll obsess over one thing, like the dividend rate or the interest rate, or is it non direct or direct recognition, or how long is the draw period, whatever. And they obsess over one component as if that's the key factor. You can never boil it down to one factor. I agree with you. As James Nethery says, if you don't understand the concept, the details don't matter. If you do understand the concept, the details don't matter. But yeah, I agree with you. Then Cameron J4W comments again and says, even you compare like a supplemental retirement, it's almost like a 401k with money market funds, death benefits, and guaranteed loan availability to 95% of your funds. Thanks for your comment. Not a bad comparison. He's saying you could look at it like a retirement account, except with money market funds, not investments. But then you have that death benefit, guaranteed loan availability, etc. Not a bad thought, Cameron. Thanks for your comment. I appreciate it. Let us know, are you personally doing infinite banking and or velocity banking? Let us know where you're at in your journey. Thanks for commenting. Cameron J4W comments again. This is on my Be an Alligator in Investing video, talking about the alligator analogy and how most of the time when it comes to investing, doing nothing is actually the right thing. Sitting on the sidelines with cash, ideally cash growing in a whole life insurance policy, is the right thing to do. So he says, in my opinion, I think when people say saving/investing, they use it in reverse. But what they're communicating is correct. Sometimes even jobs I've had will say that they have 401k savings, but it's understood money you put away for retirement years. And the phrase hope it goes up, that's more on the we don't know what the return is, but the likelihood anyone puts 100k in the market and lets it ride till retirement and them losing it versus being a lot higher than you put in are slim. A big IBC advocate, but I think the semantics in this community does hurt audiences. Almost like debating someone and they tried to win on some weird technicality. Just my 2 cents. I support this channel, and I was only 102 into making this comment. Yeah, thank you for your comment. He's replying to me making the distinction between investing versus speculating versus savings. I do think it's important to make distinctions. I agree we shouldn't get lost in technicalities. I agree because that's sometimes what I think our critics will do is they'll catch us and criticize us for saying things that are technically imprecise but are still basically correct. Whereas they will say things that might be technically correct or legalistically correct but very misleading. And I see that a lot. When they say things that are technically correct but misleading, I think we need to call them out for it because I think not that the people saying it are deliberately doing that, but I do think the people at the very top who control the language, they are deliberately misleading people. So I do think it's a problem when we refer to 401k as savings or saving for retirement. I think it's important to make that distinction. You're taking on a lot of risk. Whether it's likely or not that the 401k goes up in value is irrelevant. The point is there is a risk. Whether that risk is a large amount of risk or a small amount of risk is immaterial. The point is there is risk, and we need to call them out for that. The end result, which we see all the time of them calling 401k a savings vehicle, is that people will have a lot of debt, some of it very toxic, and they'll have no savings, but then they'll have a large chunk of money tied up in 401k jail. That's totally backwards. That's not the way it should be. Those people would be much better served if they paid off their toxic debt, had a strategy to attack the debt first, and build savings. And then after they've gotten their debt down to a manageable level and built up some decent savings, then they can start investing. I'm not really disagreeing with you. I certainly don't want to get lost in technicalities either. I don't think these people are being deliberately misleading. So I do want to be careful about that. But at the same time, I do think language matters. I do think making distinctions is important. But thanks so much for your comment. I appreciate it. Ray Bon Bon comments on my Build Your Cash Flow Machine Whole Life Plus First Lien HELOC video and says, would you use a policy loan to reduce your average daily balance on the HELOC? That's a great question. You could do that. The answer to any good question is it depends. So the answer to your question is it depends. You could. So you could pull from your first lien HELOC because everything is going through your first lien HELOC, pay a premium into your whole life insurance policy, and then immediately borrow against your whole life policy, take out a policy loan, and put that back in the HELOC to reduce the balance of the HELOC. That might be the right move. It might not be. It really depends on you. I will say that if your primary concern is just simply reducing your interest costs as much as possible, that will probably be the right move because the interest you're being charged on your whole life insurance policy loan will almost certainly be less than the interest rate you're being charged on your home equity line of credit. But if your concern is more liquidity and guaranteed access, you might not want to do that. I personally probably wouldn't do that in most cases because I value liquidity at a very high level and I'm okay paying a little bit extra in interest in order to have extra liquidity. But the beauty about this strategy is now you have full control. If you want to pull more from your HELOC and put it into the whole life policy, you can do that. If you want to do the reverse, take out a policy loan, pull more or borrow against your whole life policy for a larger amount and put that back in the HELOC, you can do that too. It's totally up to you. So now you have two complementary strategic pools of liquidity that you are building that you can use, and they can be very complementary and cross pollinate as much as you want. I would say that between the two, the whole life insurance policy, in my opinion, is far more important and far more strategic over the long run, but both are good. Thanks so much for your comment. Greatly appreciate it. Daniel Nolte 3579 comments on my first lien HELOC explainer video and says, do you have a copy to share with us of that calculator on the last slide? No. Short answer, no, I do not. That is for ambassadors only. So if you'd like me to run your numbers, you can schedule time with me and we can go through it together. There is also a publicly available calculator on the First Lien HELOC website. So if you just go to firstlienheloc.com/calculator, you can do some calculations on your own. Thanks so much for your comment. Appreciate it. Nelson Advisors says, great video. Thank you so much for making this video. Awesome stuff. Thanks, Peter Nelson. Great to have you on the show. As always, this was on our Catholic Order of Foresters video. So we're introducing the Catholic Order of Foresters. Who are they? What do they do? Why do we work with them? They are a Catholic fraternal life insurance benefit society, technically a 501c8 organization. You can get whole life insurance policies with your standard mutually held life insurance companies. You can also get them from fraternal organizations. And there can be reasons why you would do that. The Catholic Order of Foresters has a very competitive whole life insurance policy that pays a very strong dividend that can be used for infinite banking. They also do some unique things that nobody else does that I'm aware of. First of all, the most flexible convertible term policy out there, and we went through some of that in the video, including the ability to take out convertible term policies on children, which is an incredible benefit. And we talked through a few of the things that the Catholic Order of Foresters does with Matt Kornick, who represented the Catholic Order of Foresters. Thanks so much, as always, Peter. Greatly appreciated. Mr. Gavel, 2856, comments on my first lien HELOC case study, saying I would simply use cash flow index to prioritize which debts to attach first. Before combining in the HELOC, I would calculate the interest savings versus cash flow gain. Thanks for your comment. Yep, that is a great approach. That works just fine. Cash flow index works very well. It's a great way to prioritize your debts. It works particularly well when you're doing velocity banking with a first lien HELOC. So thanks for your comment. I really appreciate it. I'd also love to hear about what you're doing. Are you doing that currently? Are you doing velocity banking or infinite banking currently? Would love to hear what you're up to. Thanks so much for your comment. Javon Martin, 2250, comments on my using the first lien HELOC to invest in real estate video and says, what is the LTV you lend on with the first lien HELOC on rental property? I take it that this HELOC will report on the LLC side, not to your personal DTI. Am I wrong to say that? Thanks for your question. The answer to your question is, of course, it depends and it changes all the time. So I'm always hesitant to give specific answers to specific questions because those answers are wrong as soon as they get published because things change all the time. And it's specific to your situation. The loan to value ratio that first lien HELOCs will give you on a rental property depends on the lender, depends on you, depends on the type of property. Some of them they won't even lend on at all. But at an absolute maximum, it would be 80%, I would imagine. 80%. And that, as I say that, I'm sure it'll be wrong as soon as I publish this. And I'm sure I'll get yelled at for saying something that's wrong. If I don't give specific information, I get yelled at for trying to hide stuff. If I do give specific information, I get yelled at because, of course, it's wrong. It gets misinterpreted, all that stuff. So I have to find the right balance. When I do specifics, I try to give use cases, but it always ends up misleading people when I give specific information. So I found it's better to stick with general principles and try not to go into specific details too much because it confuses and misleads people. And the only people who want those are people who are not ever going to give me the business. They're just trying to get all the information out of me for free so then they can go and try and do it themselves or give the business to somebody else. And then as far as how it reports, again, it depends. But if you take out a first lien HELOC on a rental property, I'm pretty sure it would report to your personal debt to income ratio, unless you've gotten to the point where you've completely separated your personal from your business. Just because you have an LLC and your LLC owns the rental property does not mean that that debt instrument does not attach to you personally. It is in almost every case. And getting your personal credit separated from your business credit is a process that takes time and effort and is not easy. So it could be that the HELOC would report to your business credit on the LLC side and not be attached to your personal credit. It's possible, but there would be a process for you to get to the point where that would be the case. And if you're asking this question, then I'm assuming you have not done that. So most likely that first lien HELOC, even though it's on a rental property that's held in the name of your LLC, will show up on your personal credit report. But thanks so much for your question and your comment. Really appreciate it. Are you actually doing this? Let us know. Cameron J4W asks, this is on my health update Mayo Clinic recap video. Cameron asks, are you able to accelerate the living benefits like critical illness and such? The answer is yes. So you're referring to accelerating the death benefit, depending on the insurance carrier. All of them have typically some kind of chronic illness rider on the policy. What kind of rider it is varies, depends on the company, depends on how we structure the policy, etc. But when you say critical illness, there are some carriers where there's a chronic and critical illness rider. So if you have a critical illness like a heart attack, stroke, cancer, you can accelerate yourself a portion of the death benefit to pay for those expenses. And most carriers have chronic as well. The chronic illness rider is if you have a long term care need. If you are unable to perform 2 out of the 6 activities of daily living or have a severe cognitive impairment like Alzheimer's or dementia, then you can start accelerating the death benefit in order to pay for those expenses. And it's indemnity based, meaning it's not reimbursement based. You don't have to incur any expenses. As soon as you meet those conditions, you can start accelerating the death benefit and then use it for whatever you want. It's just cash in your pocket. He replied again and said, I get the chronic illness is a form of long term care. I think the customer guide says like it's not a replacement. I had a WL and you can get 75% accelerated from the death benefit. I am interested in a policy that offers additional riders such as true critical illnesses, but it seems that's a standalone product or some terms have it and ULs. That's a good question. There are good whole life insurance policies with good mutually held companies that have a critical illness rider. The question is, are you primarily interested in getting critical illness coverage? Is that the primary goal for you? Or are you saying, I would like to take out a whole life policy, number one, and then as part of that, I would like to have critical illness protection? So, certainly, if you want to take out a whole life policy already, then you can definitely get a really good policy with a great couple of great carriers where you do get critical illness protection. You can accelerate that death benefit if you have a critical illness. And I think that's great. But if really your primary goal is just to get critical illness protection, you're not interested in whole life, I would not recommend buying a whole life insurance policy with that critical illness rider just if critical illness is your only concern. Then I think a standalone critical illness policy is going to be better. I would recommend a standalone critical illness policy. You're going to get more robust coverage at a lower cost. One of the critical illness policies that I've sold has return a premium too, so that if you never use it, all the premiums that you paid in the policy go back to your estate. And it's guaranteed renewable for life, meaning you can keep it in force until the day that you die, which is super beneficial. So if you're 40 years old, the odds of you getting cancer are relatively low. But if you're 80 years old, the odds of you getting a heart attack, stroke, cancer, any one of those are probably better than 50-50. Yeah, I would look into a standalone critical illness policy if getting critical illness coverage is your primary concern. But thanks so much for commenting, Cameron. We greatly appreciate it. Thanks everyone for watching, for your comments and engagement. God bless, Godspeed.